But guess what, JC? I just pushed this live on Facebook, so we are live on Facebook as well. Everybody who is here in Zoom and everybody who is on Facebook, I'm watching both accounts. So let us know, where are you from? Welcome to the show. I'm coming from beautiful Laguna Beach, California. Finally in my office. I put Lola up behind me, JC. I don't know if you can see her. Lola is my cow skull I got in Mexico. I named her. I've got a really funny story getting her through. I literally brought her into first class with me. Like, I did not put her in my luggage. I did not ship it home. I brought this cow skull. It's got horns and everything. And I bring it into first class. And I asked him, I was like, yeah, can you guys hang this for me in the coat, in the coat locker? And the flight attendant's like, yeah, sure. Here, and I give her a cow skull. So this thing's international.
I can only imagine the conversation that the flight attendant had later that night. It's like, honey, how was work today? Well, this guy comes in with this skull.
Yeah, I know. It was really, I got a lot of looks because it wasn't something I think everyone's seen, which is kind of surprising because most of the people that are buying this stuff are tourists, so maybe maybe they're shipping them home. I don't know. I thought it was the right thing to do.
Shipping it home is probably the better way to go.
Yeah, I actually, I was going to say, I disagree. It was fun to get all the looks from everybody, So
still telling the story.
The story gets better on another day, another time. I'll tell you the haggling I had to do with the guy. He pulled down that. I wanted a very specific cow head, right? And he was showing me in his little shop all these different cow. And I'm like, nah, I don't want any of them. He goes, hold on a second. I'll be right back. I left. I didn't stick around for him. He tracked me down in this mart. He went into his house and pulled this off of his wall in his house. He goes, this is mine. I was like, yeah, that's exactly what I want. This is exactly what I want. And he's like, yeah, I got this for my house. So the price has gone up considerably because this is his, that he has, his favorite one. I got it for $50, buddy. $50 off the wall of this guy's house.
Love it. That's a great deal, man.
Isn't that a good deal? $50 for that thing? I was like, dude, this is amazing. It was going to cost me more to ship it home. That's why I brought it on the plane.
Oh, that's fair. Yeah.
So I was like, I'm not going to go and spend more to ship the thing home. I'm going to take this thing back with me. So anyway, that's my story about this cow skull for everybody who's joining. All right, so we got somebody here from Louisville. Great.
I'm dying to go to Louisville, man. Oh, we got buddies out there. I don't know if you guys know Andy Swan. He's been trying to get me to go down there for a while. Andy Swan, great product. Like Folio. Have you heard of it, Jeremy?
No, I haven't. I'll look it up.
Yeah, Like Folio. His name is Andy Swan. He's 7 feet tall. He's this giant dude, basketball player. And cool, the way they filter some of the stuff, they use data from Twitter. They scrape Twitter for data.
It's called light what? What is it called? Light what?
Like Folio.
Like Folio. Oh, I have heard of these guys. Yeah. Cool. I've been to Louisville because I grew up in Cleveland, Ohio. And so Louisville is 6.5 hour drive dead south from Cleveland. It's beautiful, dude. They got a lot of rolling hills. They got a big river that kind of the Ohio River. And bourbon. Yeah, they got a lot of bourbon.
I'm dying to go drink the bourbon.
Yeah, it's good, dude. Food's really good down there. The people are awesome.
Yeah.
All right, man. Well,
basketball, right?
Yes, exactly, dude. That's right, dude. It's a good. The people are amazing. The food's good. This is really cool. This is what we're talking about. This is just so everybody knows. I'll put this into the channel here. Panelists, and this is what JC was just mentioning. Check this out. This is his buddy, Like Folio. I haven't been to the site in a while. Really cool. All right. We're not here to talk about Like Folio, though. We're here to talk about JC Parets and your amazing technical analysis capabilities, your review of the markets. I'm going to kick things off to you, man. I usually start this off with stuff that I'm excited about, but I want to hear from you. Looks like, okay, here we go. I can see your screen. Take it over, JC.
Well, listen, the way I see it, we rallied to the 61.8% retracement of the entire decline. which is a perfectly logical area for markets to, they don't necessarily need to crash from here, but a digestion of those gains makes perfect sense. The bet that we've been making is not a bullish one for the past 4 or 5 weeks. And one thing I want to point out, Jeremy, and I'll just unshare this quickly. One thing I want to point out is that people are like, oh, JC, the market keeps going up. When you need to be really, really careful when you talk about the market. Are you talking about the NASDAQ 100, which is a bunch of big, fat US tech stocks that are outperforming by far everything else in the world? Or are you talking about the market? Because most stocks are down over the past month. And I think that gets lost in translation because the sexy headline is, rally off the lows, Dow makes new 6-week high or whatever it is that the headlines are. But the truth is, if you're not a lazy person and you actually go through and do the work and go look through all of the stocks, not just do it the lazy way, looking at a single index or a couple of indexes, but actually get your hands dirty, stocks are going down. Financials are making new relative lows. Industrials are making new relative lows. Those are arguably 2 of the top 3 most important sectors next to technology. We know what technology is doing, obviously, but financials and industrials are not. They're making new relative lows. European banks look terrible. We're actually shorting industrials and financials, and I think there's going to be winners and losers, and I think that this is a chop fest, and I think that it's important to recognize that this is a chop fest. Jeremy, in 2015, had a lot of good friends that were trend followers, and these trend followers were suggesting that we were in an uptrend, right? But the trend followers were failing to realize that the trend was sideways in 2015. So they kept buying breakouts and shorting breakdowns, but they were just getting whipped around. So the trend followers failed to realize in 2015 that we were not in an uptrending market, that we were in a range-bound market. Okay, so fast forward to now. Are you a trend follower? If you're analyzing the behavior of markets, you are a trend follower. You are analyzing the trend and taking advantage of it. The trend currently is not up in the stock market. So you could be, if you want to follow trends, the trend right now is that the stock market is not up. It is a sideways range at best, a downtrend at worst.
Yeah, that's good. That's good advice. Chop fest. That's a new word. I'm going to write that down. Chop fest. I'm going to send it to everybody here. We need to get a T-shirt made. You've got breakout. You're wearing the wrong shirt, man. You say chop fest on it.
Listen, shout out to Traders for a Cause. They send me this T-shirt and a few others and some wine. I mean, they just sent me a whole bunch of stuff because they were stoked that we helped them raise so much money. So that I got a shipment of Italian wine. I mean, they've been thanking me for weeks.
Oh, that's amazing, man. That's good for them. That is a good cause. I know that you're really big in part of that. So,
$250,000 we raised.
That's incredible, bro.
In a week's planning, basically.
Wow. Yeah.
Crazy.
Well,
right?
that just goes to show, Will, you're really connected, man. You got a big heart, and so does the space. Like, we're in this business of making money, so it'd be kind of really, for lack of a better word, shitty if you went in and made a bunch of money and never gave anything back, right? There's a lot of people out there that, go ahead.
For you guys out there wondering what the hell we're talking about, go to chartsummit.com and all the videos. We hosted a conference as soon as, things got bad and we realized we were going to be stuck here for a while and people needed help. I called all my friends together and we put together an online virtual conference, made it free for everyone to attend, between the US version, the India version, and Traders for a Cause put on their own between the 3 of them. I mean, we probably had about 35,000 people, raised $250,000. I mean, it was fantastic. And the presentations were sick. Like, it wasn't like, you go to most of these conferences, they're so bad. It's basically just one cheesy guru after another, pitching whatever garbage product they're pushing down your throat. This was not that. These are the top institutional analysts on earth that are just drinking buddies of mine and were stuck at home also. So they had nothing else to do. So they're like, yeah, sure, JC, I'll come on and talk about some charts. So chief strategist at Piper Jaffray, chief strategist at Bank of America, chief strategist at Oppenheimer. I mean, chief strategist at Bloomberg. I mean, on and on and on. Just the best in the business, no doubt.
Yeah, guys who've got access to a lot of tools, a lot of information. Money is no obstacle. If they want to know something, they can spend the money to go and find it.
They
And
do.
yeah, and they do. Yes, they do. So really, really cool, man. It's really cool that you were able to be a part of that. It was great. You actually, just so everyone knows, JC just wasn't a part of it. You were the one who actually orchestrated the entire thing. So Chart Summit is something that JC owns. Because of COVID, it had to be remote, but he does this in person every single year. It's a great, great time. I'm definitely going to be going to the next one. Hopefully, it's at a ski location. If we, I mean, who knows, man? This stuff is so crazy. LA just extended it until August. You know, the shutdown. So the stay-at-home orders. I mean, so we don't. I don't even know if well, by this time next year, what the world's going to look like. I do know one thing: we're not going back to normal. There's no more normal after going through something like this and how long it's been happening.
I'll tell you
But
something about normal, Jeremy, and you're probably right with respects to socioeconomics and all that, and how we're going to be living our lives. But the one thing that is more normal than anything in the world is what the stock market's been doing, because these crazy times are nothing new. We didn't invent these crazy times. These markets have seen this and worse. So the markets are, one of the most beautiful expressions of that supply and demand, pulling from both sides, that fear and the greed. The market is such a beautiful place that, things might evolve, things might change, society might be going through whatever it goes through, but the market is what's going on between our ears, all of us, that hasn't changed. And the market is the art form in which we visualize what's going on between our ears.
yeah, that's right. Yeah, good. That's a great point. Let's get into the markets, man. Let's go and talk about what we see happening. We're halfway through the month. Tomorrow's the 15th. So this is there's that whole saying that says "go away in May." Do you know where and why that ever came about? Go
I
away in May.
I do. It's an old British saying called "Sell in May and go away. Come back on St. Leger's Day." And St. Leger's is the third race of the British Triple Crown. So by the time that's over, then the traders come back to trading. In America, we call that football season, right? But at the end of the day, that's where that comes from. And the mathematics are fascinating. My good buddy, Jeffrey Hirsch, good guy. I don't know if you met him or not. Jeff Hirsch, he's the author of the annual Stock Traders Almanac. And they did the work, and you go back to 1950, and every single penny earned in the Dow Jones Industrial Average, Jeremy, since 1950, that's 70 years of data, every penny made in the Dow Jones Industrial Average has come from November 1st through the end of April. So in other words, if you bought the Dow on May 1st every year since 1950 and sold it on Halloween, you would actually have a negative return.
Wow.
Isn't that crazy?
Wow.
So, okay, so fine, great. JC, nice numbers, bro. Fine. What do we do with that? So here's what we do. We recognize that there are times, clearly based on those statistics.
Yeah.
And by the way, we've done the work and measured every other 6-month period. So it's not like, work and comparing it to other 6-month periods. This is the worst 6-month period, right? And that is the best 6-month period, alternatively. So we call it the best 6 months and the worst 6 months. But we don't just blindly sell in May and go away. Like, that's not really a thing. What we do is we look back on the prior 6 months and say, okay, did the market respect those seasonal trends, or did the market ignore those seasonal trends? Because if you look back after the best 6-month period, right, which ends now, right, at the end of April, you say, okay, how did the market do? Did the market do well, like it was supposed to during the best 6 months, or did it do poorly? When it ignores those bullish trends, that has preceded some of the worst bear markets in history. So that in and of itself is the signal. And it works in both directions, right? So during the worst 6 months, from May through October, the market's not supposed to go up. So when it does, that is very obvious evidence of accumulation and risk appetite in an environment that we're supposed to see the opposite. So, for example, people talk when after the election, the stock market started going up, even though the stock market had been going up all year. But the depending on what news network you follow, they'll tell you that they'll call it a Trump rally, which is a bunch of bullshit. Stock market had bottomed in January that year. The election was in November. But anyway, the point is that by the time the election was in November, the worst 6-month period had just ended, right? At the end of October, because people say sell in May and go away, but you have to remember to buy in November, right? There's more to it than that. So at the end of October in 2016, we looked back and said, hey, during the worst 6 months, how did stocks do? As it turns out, stocks did pretty damn well during the worst 6 months, which was another bullish signal suggesting we needed to be buying stocks very aggressively going into, at that time was the election, but it could be any November, right? Doesn't have to be an election, but the worst 6 months, the strength during that period was enough evidence to suggest buy a ton of stocks. And sure enough, 2017 was one of the greatest years of all time.
Yeah, it was a huge year and really interesting. I was not expecting such a great explanation. I actually
I got more for you.
No, I actually love it. I didn't know where go away May came from, other than I know that typically you'd see the market kind of like unwind and but all the history about where it came from in Great Britain and all that stuff, and then also the almanac stats are pretty startling. All right, so the Fed's making some major moves, right? We got some unprecedented things that they've started to do, which essentially they're buying some ETFs, some corporate bond ETFs. And so we've got some things that should be, really, really interesting to talk about. As you're pulling up what you're going to go through, I would love to go into gold. I know we've been following that market for a while, JC. I want to get into the bond markets. I want to get a further breakdown in the stock market where you're finding some opportunities. For you guys, I'd love to, everybody who's here and participating, if you're on Facebook, I'm watching the comments here as well. Let us know what ticker symbols you want us to pull up. If you got some time today, we're going to go and pull those up. So go ahead and drop in those into the chat, please. And then JC, I don't know what you want to hit first, if you had something planned or not, but I'd love to go into the bond markets. I want to talk about gold. Those are things I'm looking forward to going over with you.
Jeremy, I always want to talk about the bond markets. So
I know.
People laugh at me because they're like, "Oh, JC, I asked you about the Nasdaq. Why are you telling me about the U.S. 5-year yield?" Right? And there's wisdom in the bond market. The best traders and the best analysts in the world were former bond analysts. It's just, I see it all the time. There's wisdom in the bond market. So if you've ever seen the stock market doing one thing, the bond market doing another, be like, oh, something's up here. Bonds are doing well. They don't sell off. So even though stocks had a nice rally off the March, I call it the March 12th lows because that was the low. That's when the most amount of stocks made their low. So by the time, I think it was March 23rd or something like that, when the indexes themselves put in their bottoms. But the market of stocks bottomed on March 12th. And I would argue it peaked on April the 9th. In the office, we argue about these things. Not argue, but like discuss.
Sure.
And the boys are suggesting the week of April 16th was more the bottom because we saw, the top, because we saw one more spike. I would argue we started to see that breadth deterioration on April the 9th. Either way, tomato, we're splitting hairs here. At the end of the day, the market peaked over a month ago, right? Or a month ago. And most stocks are down since then. I think it's important to recognize that. That's number one. Number two, even before the past month, even when stocks were doing well, bonds were still pushing up against highs. Interest rates were still pushing down against lows. Copper-gold ratio looks terrible. Regional banks continue to make new all-time relative lows. To me, that's evidence that interest rates have not found the bottom. So if interest rates have not found the bottom, we probably should be buying bonds, right? And if the Fed's telling you, because people are like, oh, JC, bonds are only up because the Fed's buying them. It's like, what, so we need to give back the profits because the Fed's buying them too? Like, what? They're telling you they're buying them. Why are we going to ignore them and do the opposite, right? So, yeah, great. If the Fed's buying it, great. Even more reason for us to buy it. If they're not buying it, so what? We're still going to buy it anyway. And then if bonds are ripping and interest rates are crashing to new lows, what is the stock market most likely doing in that environment if bonds are absolutely ripping? You think that stocks are going to be doing well, breaking out to all-time highs, or do you think that stocks are going to be under pressure? And my argument is if bonds are ripping to new highs and interest rates are breaking down to new lows, which it most certainly appears to be the case, I think stocks are going to be under pressure and we want to short them. So let me just give you a little tasty taste. So here we are looking at the 7 to 10 year yield, pushing up against all-time highs. Here we're looking at the 3 to 7 year, right? So the 7 to 10 is more of the benchmark, interest rate market, right? And here we are. And by the way, just because you're at the top of the chart doesn't mean that that's resistance for people out there.
Sure. Yeah.
So the way I like to say, and I got a podcast coming up about it, pinch the y-axis. My friend Phil Perlman says he likes to do that because he says it sounds naughty. When you pinch, he's like, Phil, you're going to start pinching your y-axis? He's like, yeah, sounds naughty. So anyway, pinch your y-axis so you can see what's going on up here, right? I mean, I see plenty of room. This is the 7 to 10 year bond ETF. Here's IEI, which is the shorter term. This is 3 to 7 year, again, pushing up against all-time highs. I can show you TLT. It'll look the same. Similar, pushing up against new highs. Now, if that is the case, so then here, see how the boys put the peak in over here? When I was arguing that it was like over here. But either way, again, we're splitting hairs. The Wilshire 5000 is down over the past month. Europe is down. Brazil is down. Hong Kong is down. April 17th. This is the date they swear was the peak. Whatever. Whether it was April 17th or April 9th, not the point. I want to show you. So here we're looking. So we run these scans, and this is a global market breadth scan where we're just seeing horrible market breadth all over the world. We're not seeing strength. I mean, you look at all this red.
Yeah, it's a lot of red.
There's 2 countries that have a bullish momentum reading. I mean, it's just the drawdowns from the new 52-week lows. America is standing out by far as the best performers, right? And internationally, we're just not seeing that. So here are a couple of stocks that I like from the short side. Here we're looking at shares of Caterpillar. If you've been following me at all, you know that Caterpillar in emerging markets trade tick for tick. Copper, very highly correlated with this as well. So exposure to the base metal space. I like Caterpillar short if we're below 115 with a target down near 80. So I like Caterpillar short. So there's a lot of memory near this 115 level, right? Resistance in 2011, resistance in 2012, resistance in 2014. We broke out, right, a few years ago, and then that former resistance turned into support, and now we broke. So we want to fade that all day long. If we're below 115, we want to be short Caterpillar. And then another, when we talk about industrials, when I think industrials, even though GE is not one of the biggest industrials, like to me, I mean, this used to be when I first got in this business, now I'm starting to sound like an old man, Jeremy. When I first got into this business, Sonny, but it's true. When I first got into this damn business 20 years ago, GE was one of the biggest, I think it was the biggest company in the world when I first got into this business. And they are headquartered in Fairfield, Connecticut, where I attended university. So I went to Fairfield University. I would drive by Stanford, the Stanford campus on the way to the liquor store all the time when I was in college. And I have a lot of friends that ended up working for them. They're an industrial company that tried to turn into a bank. So they didn't go bankrupt in 08, should have probably. But I heard rumblings today that GE's is zero.
Wow.
Imagine GE.
Wow.
I mean, listen, I can't even say things like that because I say things like that and they come true. I was like, oh my God, could you imagine crude oil trading in the teens? And a week later, it went below zero. So
wow.
Again, I'm too old for this crap. Nothing surprises me anymore. GE is zero. Man, that's crazy. But we're going to bet on that, and we will be very happy if GE is a zero. That's just the way it is. We like it. We like it short. I think it goes to 4 This is General Electric. Man, here, let me pull this up quickly, just so I can get the price right on the Y. I'm terrible with the Y-axis, Jeremy.
Got to learn how to pinch it better, buddy.
Someone's listening.
Oh, yeah.
The thing is, I look through so many charts that I just ignore the Y-axis completely because it doesn't matter to me. So I can tell you everything about a stock, and I can't tell you what the price is. It's pretty much right. I could draw it for you, but I can't tell you what's on the Y-axis. So here we're looking at GE, right? You can see it.
Yep.
Lowest level since 1992. Do you remember what you were doing in 1992?
1992, I was 9 years old, and I would have been, so I was a third grader going to North Crest Elementary.
Shout out North Crest.
Yes, that's exactly right. What's up, Fort Wayne, Indiana?
So new all-time relative lows in General Electric, which if, in my experience, the relative strength is evidence of accumulation and distribution. And what do we know about all-time lows, Jeremy? We know that all-time lows are not a characteristic of an uptrend.
That's true. That is that's good deductive reasoning right there. You guys listen.
Argue with that.
We bring the highest level of technical analysis at all times. Okay, that's all we want to discuss.
All-time lows, not on the checklist of bull market characteristics. It's just what it is, right?
Yeah, we didn't make that checklist. Somebody else did. Okay, if they wanted to put it on there, they could have, but they didn't. So
they decided not to do it. So
can't argue with them.
I like it short. If we're below 6, short the heck out of General Electric. I like taking profits at 4. Probably going to 0.
All right. So William wants to know, JC, general opinion on gold. I do too. So I'm going with that one first. We'll get to a couple other, ticker symbols that people have pulled up. So let's talk.
Gold junkie, dude.
I am, man. Oh, by the way, I wanted to say something too. A great strategy for some of this, because we're coming back up and testing some of these resistance levels. It's a great strategy to start selling credit spreads, so call option credit spreads on some of these. So when we're talking about fading, a lot of people don't want to go short a stock and, bring on that margin. A really great strategy with limited risk, which is huge. Technically, if you short a stock and you're, on a margin account, you have unlimited risk to the upside because the stock could go, to the moon. So if you want to take advantage of this, you can sell the near-term option and buy a further out call option for protection. You're going to limit the amount of money that you can make. At the same time, you limit the amount of risk that you take. But call option credit spreads are a phenomenal strategy for these types of market conditions. So volatility is typically high on some of these stocks, which the implied volatility is what they think the future volatility will be. So as these markets are showing a lot more volatility this year than they have in the last 5 years, you're getting really, really good option premiums. So something to consider if you didn't want to go in short, a good strategy to utilize.
All right. How are we looking here?
Gotcha.
So here we're looking at a long-term chart of gold. This has been the target, right? 1900. Those were the former highs. As soon as we broke out last year, that was the bet, right? Well, after we got back above these levels. So I just want to give people some background. So
does anybody remember what level he always talks about? I know there's a few people that have been coming to this religiously, which we appreciate your support every week. What level is JC before he's drawing it now? So if you guys got to quickly put it in there, what level? I know I've got that number down pat. So when he said it was above, because I've been asking him about gold now for, 6 or 7 months. Can I buy gold yet? Can I buy gold yet? Can I buy gold yet? I keep asking him. And he's like, not unless it's above this, then you can. Anybody want to take a stab at that? All right.
This support in 2011, Jeremy, right? That support in 2012, and then that broke. What's that level?
1,600.
So you're looking at about 1580, 1600. We like to draw our trend lines with crayons, not with pencils. So it's never like an exact amount. It's more of like a zone. The way it was best explained to me was that think about support and resistance like a mattress, like a little kid in a hotel room jumping on the bed. That's how support and resistance is. There's a little bit of give. So think of it like that. So here we're looking at this range, 1580, 1600. That was former support in 2011, 2012, broke in 2013. And then we got back there in September and we faded it, right? That was our target. We were bullish until then and we started selling it in September. And it wasn't until we broke out above that once again this year, a few months ago, that we could say, all right, it's time to be in precious metals again. In fact, this was in February. And we said, all right, let's do this. We're buying gold and we think it goes and retests those all-time highs. I mean, listen, eventually, I think we get to 3,000. I don't see any reason why not. But there's no reason to be even talking about these things until we even get back to where we started 10 years ago, right around 1900 or shortly above that. So that's where we want to be taking profits for now and then reevaluating when the time comes. Let's see how the market absorbs that overhead supply. Maybe it rips right through it. That would be the most bullish thing ever. Remember, Jeremy, the most bullish thing a stock can do is go up, right?
Yeah,
so
right.
If we rip through that level and just ignore that former resistance, that's super bullish. Now, do we want to bet that that's what's going to happen? I certainly don't. I'm not going to bet against it, right? I'm not going to short gold, but I'm not going to be buying gold at 1900. We've been buying gold. We'll be selling it at 1900, taking a step back, and then seeing how the market is able to absorb that overhead supply from the past decade. So that's been the plan. That's still the plan. And then looking short term, I mean, I don't know about you, but I see higher lows and higher highs. I see momentum in a bullish regime. So we don't have any information, any data that has come in that has suggested that something has changed, that gold is no longer in an uptrend, that we need to change our targets. Like, nothing's changed. Quite the opposite. Nothing but constructive action, if you ask me. And then this is really the big one, I think. I think this is the one that's going to tell us we're wrong the quickest. It's GDX. So this is the index of gold mining stocks. And just look at this. We call this the Kardashian bottom, right? The bigger and more explosive the bottom, the more explosive the resolution, right? So we have the Kardashian bottom here in gold miners. And 31 is the big level. We talk about 1580, 1600 in the meadow itself, but 31 in the GDX, that's the level. So what does that mean, 31 in GDX? Well, if we're above that level, then we can approach the gold mining space from a more bullish, broader perspective, as opposed to what we had been doing prior to this breakout, where we were only picking the very, very best and being incredibly choosy. Like, I think Newmont was the only one off the top of my head that we were buying. Oh, and RGLD as well, because those were the ones showing ridiculous relative strength that were coming out in our relative strength scans and positive momentum scans, not because we were looking for gold miners. Those were just the names that were popping up, along with like Zoom and the one where you signed, DocuSign, right? Huge winner for us, huge winner for us. So these gold mining stocks, a few of them were showing up on those same scans. So that was one thing. But now, after this breakout, now just our perspective is just different. We're not running scans and then getting information about a couple of select gold miners. No. Now the strategy is, we like gold miners' bigger picture. Let's dive in, and we can just approach the whole space from a more broad perspective. See the difference?
Yeah, I do. And it's a beautiful example of your top-down approach, right? So you start to see something like a crack in the foundation start to form. Okay, you make a note of it. You don't ignore it. Is it a time to go and make a huge deal about it? Not necessarily. Then all of a sudden it becomes bigger and bigger. Now it's the big thing. It's clear. It's day. It's going to be. Now let's go and let's spend time there. Let's dive in. Let's get deep. Let's find the best opportunities and exploit it. I like talking about gold because that's exactly what we've been waiting for, this moment. First we got into just like gold, as the futures contract or, GLD, the ETF, and watching that 1600. It flipped on the 1600. Your recommendation back then was a really great strategy, which was a bull put strategy. And then as we've tested at 1600, it's gone above that. We're making money there.
Our profit target was hit, I think on Monday.
Yes, right. Because I'm following your newsletter, so I saw that come through, and so anyway, yep. Whoop, whoop. Look, I mean, this is about making money, and I just wanted to call that. It's something I just like. I have a commodities background, and so I follow those markets and just kind of have more familiarity with them. I've been studying them longer, so it's something I'm personally invested in, curious about. Hence why I wanted to get into it.
These Midwest guys, they love their commodities. They
I
can't get enough of them.
I can't, dude.
It's really funny. It's really funny. I mean, it's just for me, it's just interesting. And I'll just before we get into this next chart, just a really interesting thing. Like when you're at a bar in New York City, down on Wall Street or in Midtown, and you're in line for the bathroom, and you hear conversations. It's like, oh, this IPO, that trade, that breakout. Those are the conversations you hear. When you're in Chicago, it's way different. It's all about derivatives. It's all futures and options. Like the conversations that you're hearing, the conversations that you're having, like volatility conversations come up a lot more. Commitment of traders report comes up a lot more. It's just like, it's really funny. And then you're in San Francisco and everything's private equity, this startup. Oh, I work at this startup. I just left that other startup. Like, it's just really funny the way that society, geographically, we have different conversations. We have different interests. It's fascinating to me. I've always noticed that my whole career by accident. It was just like I would just notice. It was funny, right?
Yeah, it is really funny, and there's biases. I mean, like I said, a lot, and it's so because people's, especially in Chicago, the bulls. A lot of people understand why the Chicago would be called the bulls. Well, I think at one point, all of the live cattle in the United States would go through Chicago from the train system. So there was tons of livestock, hence, and a lot of the grains, right, were right outside. So all that stuff would go through Chicago. And so when you, as a family, you're growing up, you would know about how much cattle was there and how the wheat crops are doing, and or the soybean crops and stuff like that. You would actually, these are things that you would know as a kid, and you'd hear your parents talking about or listen to your dad kind of talking about. So then there was people started getting into speculation, and same thing in the stock market, right? In New York City, you just hear people talking about what it was like on the floor. Oh man, it was crazy on the floor. When new technology would come on the floor, people would talk about it. So yeah, it is interesting and a good point.
Actually, I mean, I might have a chart. Geographical bias. Let me see if I can find it. It's such a great chart, and it shows the changes in people's portfolio. Here it is. The availability heuristic. How about that for a nerd term? The availability heuristic. So this is one
Can
of
you
the.
imagine if that was like your spouse and you're like, talking about your dinner table, and they're like, "Oh, I'm so excited about this," and they tell I'd be like, "What?" Or if that was like your brother or something, anyway. I think about that kind of weird stuff.
The availability heuristic, Mr. Jeremy. So here's a great chart. I can't believe I was able to pull it up so fast. So it's about a year, maybe from like the fourth quarter or something like that. So obviously this data has changed, but it's not the point. This is the likelihood. So they looked at all the portfolios of people around the country and broke it down by sector. So there's a 10% higher likelihood if you live on the West Coast that you have more technology. If you are in the South, there's a much more higher likelihood that you have more exposure to energy, right? And look at there's less you're not investing in industrial stocks if you live on the West Coast, right? You're like, why am I going to buy industrials? I'll buy tech, right? Is this really funny? Isn't this chart great?
Wow, yeah, that's a great chart. Good poll.
So anyway,
I can always count on you, man, for pulling out a good chart.
The availability heuristic. In fact, if you look it up, the availability heuristic, if you can't find it, email me, but we did a podcast about it with Phil Perlman. In fact, today we just dropped another podcast. So, Jeremy, you've met Phil.
Yeah.
And great guy, mentor to me for a long time, mentor to others as well. So a lot of us, are big fans of Phil. Phil's actually a doctor, so he can bring the science into it. So I can tell him, these are the feelings I have, this is what I'm thinking, and we can speak in terms of like what I see every day. And then he brings the science behind that. He's like, well, JC, you know why you think that way? Because this and this and this. So we put out a podcast today. We call it the money game, right? Because it's all about like behavioral finance and, you know, our psychology when we're making trades and investing. So check it out on Apple, iTunes. And we talked about going about your business, right? We can't control what's happening around the world, obviously. You know, there's nothing we can do. What we can do is take care of our health, take care of our families, take care of our business, right? And because if we don't have our own house in order, we cannot help others. We have to get our house in order first, and then we can go and help others.
100%.
Great podcast. So check it out. So, okay. So that was that. Shameless plug.
He's a great guy. I'm glad that you plugged him in. Wicked smart, but he's a great human. So smart dude.
Great guy. Everybody will tell you the same thing. Go listen to all the podcasts. We've done 15 episodes, I think over probably the last year and a half. And I just mix them in with the conversations I'm having with technicians. I mean, I guess he's a technician. He's not like a CMT, but like he understands the way markets behave as good as most. All right, so here we're looking at Bitcoin. This is a chart that I wanted to bring up. I know people, audience members are always asking me about it. This is a long-term uptrend, right? Rally, consolidation, breakout. Rally, consolidation, breakout. Rally, consolidation, breakout. Rally, consolidation. What's next?
Breakout.
Theoretically. So now we have the long-term picture, right? So this is what we call a multiple time frame approach, and we can incorporate this multiple time frame approach to Bitcoin, to gold, to Microsoft, to Japanese yen futures. As long as it's liquid, we're incorporating this strategy. So we're looking at the long-term first to get structural perspective, which it's hard to argue that this is not in an uptrend, right? So you got me. We're in an uptrend. If we are going to make a bet on Bitcoin, it is going to be a bullish bet, not a bearish one, okay? Now, we break it down to the short term to confirm if and when we are going to put on any bet at all. In this case, we're looking for a bullish bet because the longer term trend is up. So there's a much higher probability that the resolution of this consolidation is higher as opposed to lower, right? So if you want to keep the math on your side, so here we're looking at the short term, and then here's what happened. So last year we had a consolidation within an ongoing uptrend, right, in Bitcoin. That consolidation should have resolved in the direction of the underlying trend, which in this case was up, but it did not. So what do we know? That this as Bitcoin approached the apex, the resolution was down. So we know from experience that there's an overwhelming amount of supply relative to the demand at that price. Let's call it 10,000. So when prices returned to that level in the fall, what happened? They were met with those sellers. We returned once again earlier this year, only to collapse. Why? We were met with those same sellers. Now here we are again last week. We got to that level and it came down once again. Why is that happening? It's because demand is in the process of absorbing this overhead supply. And again, it is a process. So the more times that a level is tested, the higher the likelihood that it's going to break. Why? Because there comes a certain point where anybody willing to sell at that level will have already sold.
Sold out, right.
And that's when the demand has finally absorbed that supply, and that's where you get the breakout. And you're going to get the 26-year-old journalist that's telling you that it's breaking out because of some bomb in Syria or whatever, you know, she makes up that morning. But the truth is, it's breaking out because the demand has finally been able to absorb that overhead supply. That's what's really happening. We don't have to make up some stupid story about why it's doing that. Who cares why?
Yeah, well, that's because there's a lot of people that like to trade off of headlines, those headline traders, those article traders. You did something there, and I just kind of wanted to call it out. So we've talked about this in other episodes. You like to go and look at the big picture from the time frame of a longer term time frame. Then you get more narrow, and the time frame shortens. Right? Can you just remind everybody why you like to do that? Because again, I like to. My job here on this show is. To be the pretty face, because God forbid JC, we trust JC for it. No. 2 is to really be the guy that like kind of adds the color and the context from an educational perspective Because I'm learning with you, JC. I was a trader. I worked.
I'm Tony, right?
Yes,
I'm going to
yes,
tell you what plays happening next.
that's right. Yes, you're the Tony Romo. I want to know how I can make money from you, buddy. And also I want to know, I want to edify myself. So I love asking questions and things like that. So this is something that you explained to me and I loved it. But just kind of remind everybody your kind of like philosophy, looking long term, then getting a little bit more narrow and then narrow and then narrower, and why you do it that way. Because a lot of people love to just stare at 5-minute charts and they never ever look at anything longer than that.
Gives me a headache just thinking about it. All the colors and the lines moving. No, thanks. Been there, done that. No, thank you. Why do we use a multiple time frame approach? Because it works. That's why we do it. No. The reason we do it is because if you're just looking at these 5-minute charts, or you're just looking at the daily charts, or whatever it is your time frame is, you're only seeing that particular time frame. So whenever in doubt, zoom out. So whatever it is that you're looking at, you have to remember that that falls within the context of an ongoing trend, whatever that trend might be. It might be an uptrend, might be a downtrend, might be a sideways trend. We don't know what that trend is going to be. But the first thing we need to do is identify what that long-term trend is, regardless of what it might take you 3 seconds. It takes no time at all, which is, it's crazy that people don't do that. I never understood that. So anyway, You start and you figure out what's it doing. People are like, oh, I think I'm going to buy Apple, or I think I'm going to buy Amazon. They just start diving into like the 10Ks and start doing all this homework. They just completely ignore. Is it going up, or is it going down, or is it going sideways, right? They just completely ignore that step. So the first thing we need to do is identify the direction of the primary trend. And the way we're able to do that is by sizing it up 1 degree higher. So for me, I don't care what happened today. I don't care what happens next year. I'll worry about next year. I don't even know what I'm having for dinner tonight, let alone, right, what's going to happen tomorrow. So I take 1 second, 2 seconds maybe, to look at the long-term picture. Then we break it down to the short term and just understand that whatever it is we're seeing is within the context of that bigger picture, right? So if we're seeing a consolidation in the daily time frame, and in the longer term time frame, it's in an uptrend, then that consolidation should resolve in the direction of the underlying trend. So I care about what's happening in the next couple of weeks, couple of months. That's my time frame. I own it. That's me, right? Through and through. I don't change my time horizon. So I care what's happening this quarter. So in order to get longer term perspective, I have to look at the weekly charts. In other words, 1 degree higher. If you're a day trader, for example, and you're looking at 5-minute charts or 10-minute charts, maybe the daily candlesticks will be your long-term time horizon, right? If you're a long-term investor, you only look at weekly charts, maybe the monthly charts, 1 degree higher will give you that longer-term perspective. So 1 degree higher, that's the way I learned it, and that's what continues to make the most sense to me.
Love it, man. I hope that helps everybody else out there too. And it's a good reminder to go and look at the bigger picture, because these short-term charts are just a part of this bigger picture. And if you're not careful and you just would have taken the 3 seconds to zoom out, you would have saw that, oh my gosh, we're hitting some huge headwind where there's a lot of resistance here. It just helps out. So I know I've been a victim of it myself, just not, taking the time to look at the bigger picture and pay the price. So, all right, we've got some stock symbols here that people wanted us to look up, but I'm sure you've got some more things that you wanted to discuss as well, JC. What are you doing over there?
I can go on and on and on, Jeremy. I think you know this by now. I want to talk to you about something quick, and then we could take a few.
Okay.
So here's what I got. So in green, we have the U.S. 10-year yield. So these are U.S. interest rates.
Yep.
Not an uptrend, right? Like the Adam Sandler Hanukkah song. O.J. Simpson, not a Jew. Not a Jew. So here, this is U.S. 10-year yield, not an uptrend, right?
Not an uptrend, not a bullish market.
This thing's been in a downtrend my whole life. Think about that. Isn't that crazy? It's crazy. And my whole life, people have been waiting for it to bottom. That's just human nature. So we got U.S. 10-year yield looking absolutely disgusting in green. And then you'll notice how high the correlation is up here. You'll notice between this black line and US 10-year yields, right? You see that? What
Yeah.
that line above is black line is regional banks versus real estate investment trusts. Why do they move together? Well, if the market thinks interest rates are going to go up, you're going to get a bid, particularly on a relative basis in regional banks. Their margins get better or whatever it is. I'm not going to pretend to know, but something along those lines. Needless to say, the correlation is there. When the market thinks that rates are going lower, the higher dividend paying stocks are going to get a sympathy bid because fixed income investors aren't able to get their yield in the bond market. So you see them going into the stock market to higher dividend paying stocks in order to get that yield. So if you look at a ratio of regional banks versus REITs, it's going to look exactly like the US 10-year yield, right? So that's why that looks like that. And as this ratio rolls over, to me, that's further evidence that interest rates are going lower. So we already said we like buying bonds and we want to buy a breakout in bonds. But what I also think that that means is that we can short the banks. So if we're shorting the banks, let me give you some love here.
I love it when you do this, man. I love it when you go and you look at one specific thing and then you see the correlation and how it actually, affects another market. Folks, this is why he makes money. This is how he helps people. This is why people pay him. This is what we're witnessing. This is what all of his members love so much. Is this ability for you to do that, JC, is awesome. So continue.
Well, I appreciate that. People love paying me for my homework, and I love doing homework. So it really works out great. So, the way I learned it from the great Luis Yamada, who learned it from the great Alan Shaw, who I'm about to have on the podcast, by the way, and I'm going to ask him where he learned all this stuff. And he's going to give me crazy stories from like the 1930s and 40s. Like, I'm so stoked. He's not young, so he's not too great with technology. So we're 0 for 2 on this recording of the podcast, but I think we're going to get it done. And if we do, it's going to be so good. He's so good. Okay, so here we're looking at, so what did Alan Shaw teach Luis Yamada? So she goes, so years ago, this is 2008. So 2008, I'm at a conference, and Luis Yamada is legendary technical analyst. She's like 5 foot nothing, little lady, right? Everybody's coming up with their fancy PowerPoint presentations and stuff like that. She's like, no. I'm printing mine out. She is up there. Nobody can even see her because this is giant auditorium, and she's like a little lady. And she's like, you see this chart? And she holds up this giant chart. She's like, you see this? Nobody can see it, obviously. I'm like in the last row. I'm like, no, I can't see it. It's like, it's Citigroup. The bigger the top, the bigger the drop. That's what she's saying. And she's holding this giant, huge top. And I'll never forget that for the rest of my life. Luis Yamada going, the bigger the top, the bigger the drop. Right?
I love it.
So, what do we have here? A massive top, as far as I'm concerned, in Bank of America. And then on a relative basis, already breaking down to new lows, had already completed that top a couple of months ago. So for me, if Bank of America is below 22 and a half, I like it short. And I hope it goes to 0, but we'll be covering our shorts at 15.
There you go. There's another trade recommendation for you, courtesy of JC. Great. I actually would agree with that as well. And I love it. Bank of America to 0. Let's see it happen.
They say that shorting Bank of America is un-American. But the truth is the ability to short companies and the ability to bet on bad companies doing bad things and being able to profit from bad companies doing bad things is the most American thing in the world. I mean, we have the freedom to do that. You can't do that in other countries.
I 100% agree with that. I would argue that's the opposite. If you think that it's un-American to short Bank of America, then you're not American, because that's not what we do here.
That's as American as it gets, and it's a beautiful thing. If you know the company's doing well and you want to bet on the company doing better, great, go do it. And if a company sucks and you want to bet on it continuing to suck, you can do that also. What's wrong with that?
Exactly, right. Yeah, more power to you.
Yeah.
Love it. Good. I will definitely take note of that. And again, that would be another great strategy based off that chart. Look at a call option credit spread. So to find risk, sell that sucker, and watch it. All right, man. So we got Bruce. Bruce raised his hand. I don't know what kind of question. I got to go back to these chats. You want to ask your question, Bruce? We could allow him to talk. Let me see if you want. You want to talk, Bruce? Here, I'm going to see if he wants to. All right, man. You got the floor. If you got a microphone, unmute yourself.
Hi there.
Hey, Bruce.
Hi. I was wondering about Codex, CODX. That thing was trading for like $3 or $4 3, 4, 5 months ago. It hit over 29 today. What's going on? I made money off of them guys in March, but that was down between $5 and 19. This is crazy.
That is crazy. What's the ticker symbol again?
CODX.
Got it. All right. Well, thank you, Bruce. Thank you for the question. That worked out really well. I'm going to go and mute you again, Bruce, so that JC, you can pull this up. If anybody else has any other questions, this is a good thing about going to Zoom, I guess, versus Facebook. We can actually get people to participate. Bruce, thank you so much. If anybody else has something, raise your hand. We'll see if we can kick the mic over to you. So
this is a little stock. It's under $1 billion. So it's not really something that, that I would feel comfortable talking about. It's pretty liquid. Traded 50 million shares today, so it's not nothing. So I can mention it. This is probably one of those situations where like a month ago I couldn't talk about it, but like now it's probably big enough that I can.
Yep.
There you go.
I'll tell you one thing, Bruce. I wish I would have long going into 2020.
Yeah, absolutely.
Right.
All right. Can you guys see that? Are you able to see that, Jeremy?
I can see it, man. We're watching.
For me, this thing's, it went from being a penny stock to absolutely ripping. So, I don't know what's going on behind the scenes. Something tells me they're up to something with coronavirus, and there's probably been a bunch of news because this stock is, this 25 bagger in a couple of months. And, this isn't India. 25 baggers like this don't happen that quite often,
That's co-diagnostic.
Listen, it's breaking out to new highs. What's the most bullish thing a stock could do is make new highs. It's probably a little bit of trouble around 26. I'd probably be taking some profits at that level. Again, this is a little stock. Under $1 billion market cap. It's 600 million market cap. So it's not really anything that, we touch, because remember, these are great. And this is, by the way, this is a good point that I want to make. And Bruce, thanks for calling. I love these, long time listener, first time caller. There's this misconception that the financial institutions, the big banks and the hedge funds have a huge advantage over a retail investor, but it's actually the opposite, because you as a retail investor, not just Bruce, anybody has the ability to buy this all day long, in a portfolio. I don't know how big your portfolio is, but I'm going to go out on the limb that say you're not going to be moving it around, right? You don't manage a hedge fund, maybe you do, I don't know. But if you're just a retail investor managing your own portfolio, you could buy these stocks. If you're a hedge fund, you can't touch it. You can't buy Bitcoin. You can't buy these small cap stocks. You can't do it because they're too small. You would have to buy the whole thing, the whole company, for it to, even put a dent into your bottom line. So retail investors can look at some of these stocks and they're playing in their own playground, right? They don't have to play in the big boy playground. It's different. So it's a huge advantage. I think this is a great example. Huge monster. Like, for example, Warren Buffett didn't just have a 25 bagger in this stock, right? But there are folks at home who are able to do that, and Warren Buffett cannot, right? Think about that.
Yeah, great point. Good question. Thanks, Bruce, for being a participant here. We
could probably do a better job, Jeremy. It's probably on us. We remind the folks, like, make it at least $1 billion market cap, so we're not messing around, down in the weeds. You know what I mean?
Yeah, there is we can definitely do a better job at that. We're doing these weekly, and I hope everybody comes back next week and invites their friends. But the reason for this, you guys, is that when the market doesn't have enough volume, it's the analysis that we're trying to apply to these marketplaces it leaves so much room for anomalies to happen and things like curveballs to come in, and people can get really, really hurt. And so that's really the bottom line for it. Can we have a personal opinion about it? Absolutely. Would JC sit there and, bullshit with somebody about it, over a beer or wine? Yeah, probably. But from an educational standpoint, which is the whole point of this, right, is to teach everybody and help everybody understand these markets better. We just want to stay away from some stocks that could potentially cause a lot of harm, or someone hears an idea that we say and they take action on it, which is not what we're telling people to do. We're not telling you to go buy anything. We're not telling you to move your money around. This is for educational purposes. And you do that, it's just not the point, right? It's not what we want people to do. So anyway, that's our little rant about that. So yeah, $1 billion cap companies and above, really, really high liquid markets. Those are the ones where technical analysis and our approach to this whole thing work the best. And we can provide.
And then people were like, well, you see, I like the smaller stocks because of the juice, right? Because of the volatility. And the truth is, the bigger stocks, sure, they may be lower beta, but if you really want the juice, you can get it in the derivatives market. There are a lot of great stock replacement strategies that if you really need the juice, you can get plenty of it. So, there are ways to take advantage of large caps and mid caps where you don't have to dig in the weeds of these little micro cap stocks, little penny stocks. For a lot of the reasons you mentioned, most of my clients, my institutional clients, I should say, can't touch the stuff just because, they're too big. They would have to buy the whole company for it to be worth it. And in some cases, it still wouldn't even be worth it. So it's a really interesting distinction that I think is important to make. And then by just avoiding those little penny stocks, like, how many of those penny stock scammers there are out there? I mean, it's just not worth it. If you need the juice, you can get it. You can get it in different ways.
Yep, 100%. All right, so we like to keep these things within an hour. We do have one guy, Ben, who raised his hand. We'll kick it to him. My team, look, before we kick it over to you, Ben, and I appreciate everybody sticking around. JC, you are literally one of a million. I mean, you are just an outstanding chartered market technician, and there's a lot of value that you can provide. So we talked about your podcast. Please, you guys should listen to that and download it. You're going to learn a ton. Invite your friends to these. If you get the next invite, forward it and bring more people to it. And then the last thing is that there's an opportunity for you during all this COVID crisis. We got a lot more time on your hands to learn. And we've got some special things that we're going to be coming out with. But if you want to participate in his program, if my team can drop the link, we've got a special price for you guys and a special deal. So go ahead and click on that. I'm going to click over to you, Ben, and allow you to ask your question. And then we're going to call it a show. So here we go. Let's see. Okay, so I'm going to promote you to a panelist here so you can talk. I think you got to accept this, Ben. All right, Ben, do you want to go for it? Here we go.
Hey, Ben.
Yes. So, hey, JC. Hey, Jeremy. I appreciate it. So I'll just keep this short. I wanted to get your thoughts on Ares, ARES, and Switch, SWCH, both of which I think are around like 4.
ARES, and the other one was Switch. I'm not sure which one's Switch. Ben? What's the ticker symbol on the second one?
I believe it's...
So it's ARES and the other one's SWCH.
Yeah, SWCH.
Yeah. All right, New York Stock Exchange listed.
This is I'm excited to hear what you're going to say about Switch.
Are you now?
I am.
It's not a gold stock.
I know it's not gold. I love gold. Everybody should be owning some gold.
Our boy Bruni, he's one of the technical analysts. He's a young guy on our team, and he's just not a movie watcher. And he's like, JC, how come every time we mention precious metals, people start talking about how much they love gold?
Gold.
All right.
Poor kid's sheltered, it sounds like.
He is. He just saw Harry Potter for the first time, so now he keeps So, I mean, listen, I'm looking at this as a pretty nice base.
Yeah.
Speaking of Kardashian bottoms, right? I mean, just a nice base there, right? So bigger picture, nice base. And you got your breakout. You know, we're in between these two retracement levels, right? So we're between 29 and 40, pretty much right in the middle. So it doesn't seem to be much of an edge in either direction here. We're basically right at the middle. So if you wanna do one of these guys, see where we're at. Right? If you want to see where we're at, you know, that 33.5 level is probably a big one. So if we are below that, you know, I think that you probably want to be a little more defensive, I think. You know, we're right there. But that to me, that's probably a big level. I would be short if we are below 33.5, probably taking profits right around 28.5. But this is, you know, Ben, this is a hot mess. This is a mess, you know. But it's a mess within an ongoing uptrend, I think. But a mess nonetheless. And I think the biggest remedy here probably is some time, right? You know, short term, I like it short better than long. But again, just for a trade. So like maybe a short-term trade within the context of this hot mess, right? That's kind of how I look at it. And then switch. I mean, listen, I like this is an interesting. We can.
Right.
Right. So here, what are we seeing? That former support turned into resistance, and that's still the big level. Right. So what do we do here? We took the high from the IPO in 2017 down to the low. Let's make sure we have all the most recent data. Down to the low, right? Just ballparking it, just eyeing it. Let's call it 25 at the highs, 630 down near the lows-ish. And the 61.8% retracement of that entire move is right around 18 bucks, right? So that 18 bucks just so happened to be some trouble back in 2017, 2018 before the big collapse. And then that turned into resistance earlier this year, and now is resistance again. So it's interesting how it's really battling this level. And then if you show it short term, there's that level, right? That level right there, 18 bucks, that's this level, 18 bucks, that's been so much trouble. So an upside resolution above that, you know, if we're holding above 18, particularly on a weekly closing basis, you know, I like to take a shot there. I mean, I got no problem with that, with a target up near 25. But if you can't, if we're not above 18, can't own it with a straight face.
That makes sense.
What do you think, Ben? How'd I do?
That sounds good to me, yeah. Yeah, you definitely saw something there I didn't see. So
That's
what stood out that you didn't catch?
Huh? Oh no. Just your perspective on it, like seeing, you know, how you saw the levels there, where those important levels there. I'm like, all right. I'm still learning here.
The market is basically telling us that those are important levels, right?
Right.
So we should probably listen.
Yeah, absolutely cool. Thank you for that.
You got it.
Yeah, thanks so much, Benjamin. Appreciate it. So yeah, man. So JC, that's why I thought this chart was super interesting, right? The thing IPOs, and then it's kind of has this big trough. Now it's coming right back. So it's got some unprecedented territory hitting it, but it's been hitting it a couple times. And, you know, so I was like really interested to hear what you were going to say, kind of what your overall opinion was about the thing. This is one of those things where, you know, like, you know, there's opportunities everywhere, you guys, to go long, to go short. But the way that he was able to break this thing down, and I also want everyone to see that this was, I mean, you know, Benjamin, yeah, we didn't ask you to send us what ticker symbol you were going to send us before you came on here. You know, like this is all raw and real. So the fact that we were able to, you know, see your process in real time, JC, was amazing. So my team dropped the get access to all star charts now access here. So everyone click on that link. And JC, you're a gentleman, you're a scholar. I can't wait to see your new place. By the way, guys, he's in his new place right now. So super stoked to see this. This is going to be like an evolution of how amazing your new studio is going to be. And so congratulations on that. Benjamin, thank you for your participation. Bruce, thank you. Next time, guys, Ben, do me a favor, invite 3 people. Bruce, you do the same. Everybody else, please do. If you guys have any questions for us, let us know. JC, I'll see you next Thursday, my friend.
Later, brother.
Thanks, guys.